Good afternoon, ladies and gentlemen. Welcome to RSM Budget 2020 webinar. It is indeed, we are really delighted that you can join us in this webinar. COVID-19 is indeed nasty. It has turned the world upside down and Singapore has not been spared. We are pleased to note that the government has taken immediate action and it has introduced measures to counter this and to assist the people. We at RSM Singapore would like to share with you today in terms of what was introduced in the budget. Our speakers will be our directors, Ms. Chua Hui Ting and Mr. Su Chong Ho. Without further ado, I'd like to introduce Ms. Chua Hui Ting, who will share with us the insight of this year's budget.
Hi everyone, good afternoon to all of you. Thank you for joining us in our RSM Singapore Budget 2020 webinar. The budget this year is a well-thought and assuring one. Many government measures are put in place to help enterprises and individuals tide over this difficult time. And not just short-term measures. The government also did not lose sight of the long-term goals of growth and transformation and has continued to build on the roadmap laid out in prior years. In the next 20 minutes or so, I'll be walking through review some of the budget initiatives and measures, followed by my colleague Chong Ho, who will share with you the second half of the session. In all, we'll be talking about stabilization and support package, refinements to the various tax schemes and incentives, and also the extension and lapse of tax schemes. The stabilization and support package was introduced to address near-term challenges caused by economic uncertainties and the recent COVID-19 outbreak. And in my opinion, it's commendable that the government has put in place such a comprehensive package within a short span of time. And this package aims to bring stability to the economy and support to the individuals, to the workers, for them to stay in their jobs, and for enterprises to manage their cash flow during this difficult time. As a start, let us take a look at the tax rates. For corporate income tax rate, there is no change, and it will remain at 17% since year of assessment 2010. Without a need to change for the last 10 years, I think it is still competitive and relevant at 17%. And it is one of the lowest in the region, with just Hong Kong behind at 16.5%. So this being very competitive and taking into account the tax rebates and exemption is one of the lowest in the region. For goods and services tax, I think most of you will have come to know, as a piece of good news here, there is no change to GST rate, and it remains at 7% until 2021. And the government plans to increase the rate to 9% sometime from 2022 to 2025. And the deferment of the GST increase is understandable in the face of the current economic outlook and the COVID-19 outbreak. Stability and support is really required at this juncture. On a side note, even though I'm disappointed that there is no personal income tax rebate, there is unfortunately still a corporate income tax rebate, and it's given for year of assessment 2020 at a 25% cap at 15,000. It's an increase from the previous year of assessment 2019 at 20% cap at 10,000. Next, we see an extension of the ECI installment plans. ECI stands for Estimated Chargeable Income, and ECI is to be filed within 3 months from the financial year of a company. And taxes, the estimated taxes, will have to be paid accordingly. So currently, the installments available will be 6, 8, and 10 installments based on which months you e-file. Under the proposed change, there is a 2 months free, interest-free installment, making it 8, 10, and 12 installments. So for companies that are paying huge taxes, do take note of this, and it's advisable for you to file your ECI as soon as possible so that you can take advantage of that maximum 12 installment to manage your cash flow effectively. capital allowances on plant and machinery is allowed under Section 19, under the 6th schedule, over 5, 6, 8, 10, 12, 16 years, or under the accelerated claim under Section 19A1, which is over 3 years. Currently, with the proposed change, there is an option to write off over 2 years, just for YA 2021. And the first year will be 75%, followed by the remaining 25% in YA 2022. And please note that there is no deferment, which means that in the first YA, which is YA 2021, if you opt to claim that 75%, in the second YA, which is YA 2022, you will need to claim the remaining 25%. This is unlike the current capital allowances rule, which still allows for deferment in subsequent YAs. And do note that the option is irrevocable. Under the 6th schedule, as I mentioned earlier, capital allowances are allowed to be claimed over 5, 6, and ranging up to 16 years. And now there is this option to streamline the number of years of claim. So for those that are 12 years or less, there's a choice of 6 or 12 years. And for those years of 16 years of claim, you have a choice now of 6, 12, and 16 years. And this is applicable to plant and machinery acquired in or after financial year 2022. And for assets acquired prior to financial year 2022, no claim has been made. For renovation and refurbishment, in short, we call it R&R, you see similar changes, similar to the capital allowances claim that I mentioned. There's acceleration of tax claim to help companies manage their cash flow so that they can have more tax claim upfront initial year to help them out in this difficult time. And under the current treatment for R&R, tax deduction is allowed over 3 consecutive years of assessment and is capped at 300,000 for every relevant period of 3 consecutive YAs. Under the proposed change, just for YA 2021, which is financial year 2020, there's an option to claim R&R deduction in 1 YA. However, the cap of 300,000 will still continue to apply. And this is a bit disappointing because there are some companies who incur much more than this 300,000 capping will be denied of further tax deduction claim. This is particularly for some companies who are involved in quite high volume of renovation, probably in sectors like hotel, retail, F&B. They may generally incur more R&R costs that are part and parcel of their business operation to stay relevant and competitive. So for such cases, if a company hits the capping of 300,000, even with this proposed change of acceleration of claim over 1 YA, it does no impact to them at all. So do note of this, it may not be so useful for companies that already hit the cap of 300,000. And do note this option is irrevocable. We come round to the enhancement of loss carryback relief scheme. Currently, qualifying deductions may be carried back for immediate preceding 1 YA and is capped at 100,000. So it's a situation where a company is not in a tax-paying position in a YA, and likely this company will have tax losses or unutilized capital allowances. And this company could opt to carry back in an immediate preceding YA before that and cap at 100,000. So under the proposed change, the qualifying deduction for YA 2020, just for this YA only, may be carried back up to 3 immediate preceding YAs, and a cap of 100,000 will remain the same. Companies may elect to carry back this estimated amount of qualifying deductions available for YA 2020 before the actual filing of the tax returns, which could be months down the road, so that this can actually provide for quicker refund, revision to tax assessment, so that this can improve the cash flow of companies. Here is an illustration of how loss carryback relief scheme works. And this illustration is good in a sense it shows you whether carry back or carry forward which is more worthwhile. It need not always be a carry back position is more beneficial, but it all depends. So let me illustrate this. For year of assessment, YA in short, YA 2020, you have a tax loss of 100,000. And the 3 YA prior to that, YA 171819, there's a total tax liability of $4,717. In the subsequent YA, which is YA 2021, the tax position is $8,075. Here, the company has an option to either carry back to 3 YA and save taxes of $4,007, or carry forward the 100,000 to YA 2021 and save taxes of $8,075. So here it's very clear. Carrying forward saves you 8,000 instead of 4,000 plus. So which is more beneficial in this situation? Definitely it is the carrying forward to YA 2021. So you may ask, how is it that all the years the tax rate remains constant at 17%, but you can have a differential in the tax paid based on this illustration? It's because of the partial tax exemption of the corporate tax rebate that results in differences in the effective Singapore tax rate in each of the years. So you've got to be mindful there is such a thing, and to ascertain yourself which is better, carry back or carry forward, do your maths and see which is more beneficial so that you can get the maximum benefit out of this. Here is a snapshot of the other non-tax stabilization and support measures. Not exhaustive, but I'll highlight the salient points. First is the property tax rebates. It's being introduced in a range of 10, 15, 30% for qualifying commercial properties for the year 2020. The qualifying commercial properties will include hotel buildings, service apartment buildings, conventions, and even premises of tourist attractions. For SME working capital loan, it is introduced in 2016 to help SME get financing for their working capital. And this year, we see an increase in the loan quantum and government risk share for a year from March 2020 under the Enterprise Financing Scheme SME Working Capital Loan. Also, there is a 1.5 month rental waiver for commercial tenants in government-owned or managed facilities. And here, hawkers or enterprises that are operating in government-owned or managed facilities will stand to gain, have this waiver so that they can help in their cash flow. An 8% wage offset is available for 3 months under the Job Support Scheme to help enterprises retain local employees. And there is also an increase of wage ceiling cap and government co-funding limit under wage credit scheme. Last but not least, there's a 50% port dues concession provided to cruise ships and regional ferries for 6 months. This is with the hope that these industries that are directly hit by the COVID-19 outbreak can have some form of relief. We have now come to the refinements to tax schemes. And the budget sees an extension and enhancement to DTDI scheme. DTDI stands for tax deduction, double tax deduction for internationalization. And it is a very popular scheme for companies to get double deduction on their internationalization efforts. Currently, there's a tax deduction of 200% allowed on qualifying market expansion and investment development expenses. No prior approval is required for the first 150,000 on the following: overseas business development trips or missions, overseas investment study trips or missions, participation in overseas trade fairs, and participation in approved local trade fairs. However, this is scheduled to lapse after 31st March 2020. With the proposed change, good news, it is extended till 31st December 2025. And the scope is enhanced to cover third-party consultancy costs, new overseas business development to identify suitable talent and build up business network. Also, new categories of expenses incurred for overseas business missions are also included, and these are fees incurred on speaking spots, to pitch products or services at overseas business and trade missions, and transporting materials, samples used during the business missions, third-party consultancy costs to arrange business networking events to promote products or services. And these are for expenses incurred on or after 1st April 2020. Next, we will see the extension of the M&A scheme. In short, M&A, which means merger and acquisition scheme. This is a very generous scheme which gives very good deduction as well as stamp duty relief. And specifically, the tax benefits under the M&A scheme are M&A allowance, stamp duty relief for acquisition of ordinary shares, tax deduction on transaction costs incurred. One of the conditions to fulfill in order to get this M&A is that acquiring companies must be held by an ultimate holding company that is incorporated in and is a tax resident of Singapore. However, on a case-by-case basis, currently, this condition may be waived. And this M&A scheme is scheduled to lapse after 31st March 2020. Under the proposed change, unfortunately, stamp duty relief will lapse for instruments executed on or after 1st April 2020. And if you have M&A deals in the pipeline, do take note of this date. And if possible, you may wish to execute your M&A deals prior to that so that you can still take advantage of the stamp duty relief. One of the conditions, like I mentioned earlier, is that the acquiring company must be held by ultimate holding company incorporated in and tax resident of Singapore. Now, this condition is strictly need to be adhered to, and there is no more waiver. This is clearly that the government wants to have this tax benefit directed at homegrown SMEs. And this is applicable for acquisition made on or after 1st April 2020. M&A scheme will be extended till 31st December 2025. Here we'll take a look at the Section 13Z. Section 13Z is a provision that provides for the non-taxability of gain on disposal of ordinary shares if the divesting company holds a minimum 20% of the shareholding and held it for at least 24 months prior to disposal. However, it does not apply to disposal of unlisted shares in an investee company that is in the business of trading or holding Singapore immovable properties other than the business of property development. And by right, this scheme is scheduled to lapse after 31st May 2022. Under the proposed change, the exclusion scope will be expanded to include unlisted shares in an investee company that is in the business of developing immovable properties, and also unlisted shares in an investee company that is in the business of trading, holding, or developing immovable properties overseas. So these above changes will apply to shares disposed on or after 1st June 2022. So from now till 1st June 2022, there's still a bit of time, so companies should take note and plan ahead. And this Section 13Z will be extended till 31st December 2027. And this is very welcome because Section 13Z gives upfront certainty on the non-taxability of ordinary shares disposal, the gain of it. And this will continue to provide for Singapore as the ideal holding company position. Here, we will talk about the refinement of the tax treatment of capital grants. For the purpose of completeness, I'll talk about both capital grants as well as revenue grants. Currently, the capital grants is not taxable in the hands of the recipient. And when the recipient uses the capital grant to buy equipment, the equipment will be allowed capital allowance. Conversely, for revenue grants, it is taxable in the hands of the recipient. And if that company uses the grant, the revenue grant, to defray its operating expenses, these operating expenses are claimable, subject to the general deduction rules. So what is the change now? For capital grants, there is no change to the tax treatment. It's still not taxable. However, if company uses the capital grant to buy equipment, the equipment now no longer is allowed capital allowances. And this is because the government stated that there should not be double incentivization. So this is for capital grants approved on or after 1st January 2021. Coming up next is the refinements to tax incentives. And I'll hand the time over to my colleague Chong Ho, who will walk through review the second half of this session. Thank you.
My name is Chong Ho. In the next 15 to 20 minutes, I'll bring you through the budget changes to certain tax incentives in Singapore. First off is the GTP incentive. Under the GTP incentive, a concessionary tax rate of 5% or 10% is granted on income derived from qualifying transactions. If your qualifying commodity is in liquefied natural gas, a concessionary tax rate of 5% would apply, regardless whether a concessionary tax rate of 5% or 10% applies to your other GTP commodities. The GTP also grants a concessionary tax rate of 5% or 10% on conducting structured commodity financing activities in Singapore. This incentive is scheduled to lapse after 31st March 2021. To further and strengthen Singapore as a global trading hub, we are glad to know that the incentive will be extended till 31st December 2026. However, the concessionary tax rate of 5% on LNG transactions will lapse after 31st March 2021. With this lapse, LNG will be treated no differently from the other GTP commodities. Existing GTP entities can continue to enjoy the 5% till the end of their award. Qualifying activities under the GTP SCF will now be subsumed under the GTP from 19 February 2020, and the GTP SCF will lapse after 31st March 2021. With this lapse, existing GTP companies granted the GTP SCF can continue to enjoy the tax rate till the end of their award. So GTP companies will now be able to enjoy income from SCF activities in their GTP incentive. Going forward, companies may want to consider conducting their SCF activities in Singapore. Also, if currently you're conducting your SCF activities in a related company different from the GTP entity, going forward, you may want to consider moving these activities into the GTP company to enjoy the concessionary tax rate. One of the operation needs of a GDP player, a global trader player, would be the ability to access competitive financing. And such competitive financing may not be available in Singapore all the time. One of the wish lists is to be granted a withholding tax exemption on interest payments to non-residents. However, this was not granted in the current budget. Going forward, we hope that the government can consider this as such withholding tax exemption on interest is available under other tax incentives such as the FTC incentive as well as the Maritime Global incentive. Next, we'll go to the FTC scheme. The FTC scheme grants a concessionary tax rate of 8% on income from qualifying activities. And to enjoy the tax incentive, one of the conditions is that they can only use funds from prescribed qualifying sources. This is scheduled to lapse after 31st March 2021. To continue to encourage finance and treasury functions to be carried out from Singapore, this incentive is extended till 31st December 2026. Currently, as what I mentioned just now, the FTC can only use funds from prescribed qualifying sources. This is expanded to include funds from issuance of convertible debt securities from 19 February 2020. This is a welcome move as currently the funds from the issuance of convertible debt may or may not qualify as a qualifying source of funds, because convertible debt is generally treated as a hybrid instrument which does not fall squarely into the prescribed list. Okay, the qualifying activities will also be expanded to include transacting or investing into private equity or venture capital funds that are not structured as companies. Currently, the FTC is allowed to invest or transact in shares of any company. This will help to widen the investment portfolio of the FTC. Next, we go to Section 13H. 13H is an incentive for venture capital. Under 13H, this is a tax exemption grant. There is tax exemption granted on the following income: divestment gains from qualifying investments, dividend income from foreign companies, and interest income arising from foreign convertible loan stock. And one of the conditions for this 13H is that the fund should be incorporated and based in Singapore in the form of a company or a partnership. This incentive will actually lapse on 31st March 2020. Okay, this to further encourage venture capital funding in Singapore, this incentive is actually expanded to 31st December 2025. On top of that, the minimum condition that the fund must be incorporated in Singapore is now expanded to include foreign incorporated companies, as well as Singapore variable capital companies. This is a welcome move, and as the VCC, the framework for the VCC is recently launched in January this year. The qualifying activities will also be expanded to include relevant items of the specified income from designated investment list for fund incentives. This expansion is greatly welcome as it improves the attractiveness of this 13H incentive, as currently the scope of the tax exemption is rather limited. However, it remains to be seen whether whether 13H will still apply, whether there will be conditions applied, as a 13H incentive is generally to incentivize venture capital funds for startup companies in Singapore. Under the 13H, you are also granted an initial period of up to 10 years for the incentive. It may be extended for another 5 years, and the maximum incentive period is for 15 years. Under the budget, the maximum tenure of 10 years for the first tranche will now be removed. However, the 15-year cap on overall tenure of the tax incentive of the tax exemption remains the same. Under the current budget, 13H fund is now allowed to claim GST incurred on expenses at a fixed recovery rate to be determined for the industry. As such, this will help to decrease operating costs of setting up the 13H fund in Singapore. Tied to the 13H is actually this incentive or fund manager incentive. This incentive grants a concession tax rate of 5% for the income from management of such VC funds. Under this 13 FMI incentive, the incentive period is also tied to the 13H incentive, where it's granted for initial period of up to 10 years, may be extended for another 5 years, and the maximum incentive period is 15 years. Under the budget, the total incentive tenure allowed will be removed. Instead, each award will be set at a maximum tenure of 5 years and can be renewed subject to meeting the conditions. This 5-year tenure for this incentive is consistent with most of the other tax incentives provided by the Singapore government. And this will also lapse on 31st March 2020, but is extended for another 5 years to 31st December 2025. Next, we go to the maritime sector incentives. Under these incentives, we grant tax exemption or tax concession tax rate to ship operators, maritime lessors, or providers of shipping-related support services. One of the schemes available under the MSI is the MSI Shipping Enterprise for Singapore Registry of Ship, MSI SRS Award. Under this scheme, tax exemption is granted for income for operating of Singapore flag ships. Under the budget, tax exemption is granted for income from operation of ships provisionally registered with the SRS, regardless whether a permanent certificate is subsequently obtained. Where a permanent certificate is not obtained, tax exemption is granted for up to 1 year from the date of issuance of the provisional certificate. This is for qualifying income derived on or after 19 Feb 2020. Another scheme for ship operators is the MSI Approved International Shipping Enterprise, the MSI AIS Award. As we are aware, the MSI AIS is there's an application required to be made to the MPA, and you need to get the approval before you can enjoy the tax exemption. Whereas for MSI SRS, as long as you meet the conditions, you will be automatically granted the tax exemption. Under this MSI AIS, tax exemption is granted on the operating income on operating of foreign flag ships. Under this MSI AIS, an exemption is also granted to in-house ship management income derived by the MSI AIS parent company or a managing company approved by the MPA. This exemption is now expanded to include ship management income derived by MSI AIS sister company and the MSI AIS local subsidiary. It remains to be clarified whether what will qualify as a sister company and whether there will be shareholding requirement to qualify as a sister company and as a local subsidiary. There is also a schedule to the MSI AIS for entry-level players will also be scheduled to lapse after 31st May 2021. This is extended till 31st December 2026. Another scheme under the MSI is the Maritime Lessor MSI Maritime Leasing Ship and the Maritime MSIML Container Award. Under these two schemes, a tax exemption is granted on the leasing of ships, and a 5% or 10% is granted on the leasing of qualifying sea containers and related intermodal equipment. 10% concession tax rate is also granted on the management of approved shipping enterprise, approved shipping investment enterprise, or managing an approved container investment enterprise. Under this MSIML, stamp duty remission is granted on acquisition of shares in the SPV if the approved shipping or container investment enterprise is listed or will be listed on SGX within 6 months from the date of the transfer. It remains to be seen after the remission is lifted whether there will be more acquisition of the vessels and the containers directly as opposed to acquisition of the shares, as currently acquisition of containers and ships do not attract stamp duty in Singapore. And also, any gains from the subsequent disposal of the vessels will also be exempt from tax. This MSIML is also scheduled to lapse after 31st May 2021 and is now extended till 31st December 2026. There is also another scheme under the MSI, which is the MSI SSS scheme for providers of shipping support services. There's no change to this scheme except that it's also extended till 31st December 2026. One of the key features of the MSI is a withholding tax exemption granted on qualifying payments to non-residents on qualifying financing arrangements to finance the construction or the purchase of qualifying assets, such as the ships or the containers. This withholding tax exemption is extended to 31st December 2026. As we are all aware, this withholding tax exemption is automatically granted. However, companies will need to submit a form to the MPA on every financing arrangement to self-declare that interest that you make to non-residents satisfy the condition for the withholding tax exemption. Next, we'll go through some schemes that are given extensions or which are allowed to lapse. One of them is the LIA, the Land Intensification Allowance Scheme. This scheme is actually provided to encourage the intensification on the use of industrial land. This is generally granted to manufacturers and logistics service providers to carry out qualifying activities under the LIA building. Under the LIA scheme, it provides for initial allowance of 25% of qualifying capital expenditure and an annual allowance of 5% upon the TOP of the building. This is scheduled to lapse after 30th June 2020. There is also another writing down allowance on purchase of an indivisible right to use an international submarine cable system. This is generally granted to a telecommunication company. This is also scheduled to lapse after 31st December 2020. These two schemes will be extended till 31st December 2025. Currently, there is also a tax exemption granted on income derived by non-resident mediators or arbitrators from mediation or arbitration work carried out in Singapore. This is scheduled to lapse after 31st March 2020. This tax exemption is now granted an extension of time for 2 years to 31st March 2022. Non-resident public entertainers are also subject to a withholding tax at a rate of 15% on gross income in respect of services performed in Singapore. As a concession, the withholding tax rate of 15% is reduced to 10%. This concession is scheduled to lapse after 31st March 2020. Under the budget, the 10% withholding tax rate will be extended for another 2 years till 31st March 2022, and it will lapse thereafter. With the lapse, the next time you attend a Zhou Jielun or Zhang Xueyu concert, the price that you have to pay for a ticket may be even more expensive than now if such withholding tax cost is passed on to concert goers like us. Last but not least, there are lapse of 2 schemes. One is the Section 14E scheme, further deduction for R&D expenditure incurred on approved R&D projects conducted in Singapore by the business itself or by an R&D organization on its behalf. It's not surprising that this 14A is allowed to lapse, as there are other R&D schemes provided by the government that the company providing R&D services will be able to access to. One of them is the Section 14D and the 14DA tax deduction, which together allows for a tax deduction of up to 250% of the qualifying R&D expenditure. There are also non-tax schemes, such as the RISC scheme, which is the research incentive scheme for companies. That one, under that scheme, you will actually get, the government will co-fund your qualifying R&D expenditure incurred by eligible companies. The angel investor tax deduction scheme will also be allowed to lapse after 31st March 2020. Under the angel investor tax, there is also not surprising for this angel investor tax deduction scheme to lapse, as there are other schemes provided by the government that can help all these startup companies in Singapore. For instance, the startup companies in Singapore can actually access the Startup SG scheme, which actually provides a holistic support in the form of co-investments, loans, grants, or even mentorship on the provision of physical space. With that, I end the presentation this afternoon. Next will be the Q&A session.
We have now come to our Q&A session. Thank you very much for staying with us. As you can see in front of me is our panelists to take the Q&A. On my extreme left is Chong Ho, who you know already, and Chua Wee Teng. And we would like to welcome Cindy Lim, one of our tax partners. I hope what they have shared is something that you have some takeaway with, and you find that useful, and you know what to do with the budget measures that were introduced. Now, obviously, as we now know, there are lots and lots of stuff concerning the virus, which is rightly so. So if anything, I think there's a lot that has been introduced, but question one asked is that enough? Because everything is so uncertain now. And what I'd like to do is to kick off the panel by asking them to share in their personal view, what do they think of our budget? Is that enough, or more could have been expected? So if I may, can I kick off with Cindy?
Okay. I think everyone will agree that the government was very prompt in dealing with COVID-19. Yeah, the minister probably round up his team day and night following the announcement of this outbreak. Yeah, but it is definitely, the right emphasis. Emphasize on the cash flow. Businesses need money to be put in their hands. In this slowing economy, right? Cash is definitely king, and it could mean a survival to a business. Yeah. So, the measures, my colleague, we think has already outlined them. Yeah. And the other prong of it is the longer term plans. There are also lots of provisions to transform and grow your business during this slow period. Government certainly has introduced a lot to try and help businesses to cope with the crisis, and it's timely that businesses should perhaps take advantage of it, and then have some long-term plan. Think about the internationalization, strategies that you may have. Certainly, there are, incentives there for you to tap into. Yeah, and the other thing is, I think, businesses shouldn't forget about employees. This is timely, right time to, upskill or, upgrade your staff's capabilities so that they can cope when the upturn comes. Yeah.
Talking about employees, do you think they should have at least introduced some kind of rebates for personal tax, for example?
Yes. Certainly, that's what I would like to see, but we are kind of disappointed.
Okay. We think, what do you think?
Personally, for me, I think I second what Cindy shares. The government is very prompt, and I'm happy to see that because COVID-19 outbreak is quite recent, I would say, and for the government to put forth such a comprehensive package is really notable, commendable, and I'm glad to see that there is a good balance of the assistance given to both enterprises as well as individuals, because during this period, I think enterprises as well as personally for us, we all feel the effect, whether it's on the economic, social, and all aspects of our lives. So the help is timely, and I'm also glad to see the government's assistance directing to industry directly hit, as well as those suffering from the ripple effect as well. So good measures, and like what the minister says, they are looking into it closely, and they will step up the effort of relief if the situation so warrants.
Okay. Well, the immediate impact is great.
Yeah.
So do you think they have done enough, or it could have been better?
They would have, it would have been good if I'm given personal tax relief, like the personal tax rebate, for instance, yeah. But in my opinion, I think this is good enough at this juncture with a wide array of assistance given, yeah. But more can be done if things doesn't brighten up, and we will keep a lookout at what government's efforts to step up. Yeah.
So to me, deferring the GST for another year,
Yes.
that indirectly also helps.
Correct.
Okay.
Yes.
What about you, Chong?
I think my two colleagues have said all I want to say. But I think on the tax incentive front, actually we see a new trend that any extensions are given only extension of 2 years as opposed to the typical 5 years. Actually, I think that's the government's way of trying to review all these incentives or extensions on a more regular basis to assess its usefulness or relevance, so that we don't drain our reserves of the country unnecessarily. I think that would be the trend going forward.
Yeah, and with BEPS in the picture, things are changing every day.
Right.
So you just don't know. So you cannot plan long term in terms of incentive.
Right.
Because the whole incentive may work against us.
Right.
If BEPS kick in with what we think it would. Okay. I guess now we will try and answer the question that were raised. I've got some questions here, which I will try and address them, and one of the panelists will give us the answer. First question is concerning loss carried back. The question is, under what circumstances I would not want to carry back the available YA 2020 losses to the profitable years or the preceding years? Chong Ho, you want to have a go at this?
Okay. I think Wei Ting just now has illustrated already that the carryback may not always be beneficial. It depends on the company situation. I think you still need to need to do a calculation whether the carryback will be beneficial to you or not. That's because there is the partial tax exemption granted, as well as the tax rebate that is granted. And also, 2021, I mean, the government has only announced tax rebate up to YA 2020. They have also not announced whether any tax rebate will be given for 2021. So in that case, if 2021 is also given a rebate, then you still need to calculate whether is it really beneficial. But then again, this is on hindsight, because as at now you need to make the decision already. So I guess based on that current illustration that Wei Ting has made, you just need to do the calculation to see whether all these loss, whether a loss carryback is actually beneficial to you.
In short, it's not necessary that it may be beneficial.
Correct.
Okay. So that's the answer to that question. Next question is concerning accelerated capital allowances claim over 2 years for plant and machinery for those acquired in FY 2020. Question is, can my company claim the accelerated write-off over 2 years on the entire cost of the asset acquired if the asset in question is bought under a hire purchase agreement? Maybe we want to attempt this one.
For this answer, if you acquire an asset under HP, you are allowed to claim capital allowances over the entire cost. So the CA claim, the capital allowances claim, will be based on the repayment amounts in all the years of the hire purchase payouts. Yeah, it can,
Yeah, which is really what you incurred.
Yes.
So those that have not been paid, you can't. Okay, okay, okay. The next question I have is concerning renovation and refurbishment expense claim. Question is, as the cap of 300,000 R&R expenditure for every relevant period of 3 consecutive year assessment still applies, what if the company had already exceeded the threshold of the 300,000, taking into account the R&R expenses incurred in YA 2019 and 2020? Does that mean that company cannot benefit from the accelerated R&R deduction claim? I thought Chong Ho may want to have another go at this as well.
Yeah, correct. So if you have already utilized the 300,000 in your earlier YAs, actually this will not be of any benefit to you.
Yeah. So if you have done it, then really you can take advantage of this one.
Correct.
Okay. Again, it depends on your when you incur them. Yeah. Okay. The next question I've got is concerning tax treatment of expenditure funded by capital grants. As the proposed change in the tax treatment for capital grants is only to take effect from 1st Jan 2021, if the company is lucky enough to have a capital grant approved this year, which is 2020, I can continue to claim tax deduction or capital allowances on the expenditure funded by such grant. Is that correct? Cindy, you want to talk about this?
I think in the absence of any clarification now, certainly the current practice should still apply until we come, to 1 January next year. Then, the proposed changes will kick in. But having said that, even if you were to put in the application now, I won't be surprised that the government or the government agency would kind of scale back the approval of such applications. I think, so we shall see. Yeah?
Okay, okay. Further clarification is really needed.
Yeah, I think so.
Yeah.
I think so.
Okay, one more question is concerning GTP SCF. The question here says, the qualifying activities of GTP SCF will be subsumed under GTP with effect from 19 Feb 2020. Does this mean no separate application will be required for such qualifying activities? Chong Ho, you talk about it?
So under the budget documents, right, it's not clear whether this concession will apply to the GTP company automatically or a separate application will still be required. So we wait for ESG's further information, which they say they will issue by May of 2020 this year. Yep.
Okay, okay. Okay, the next one is concerning M&A. Understand that the merger and acquisition scheme has been extended. Have the IRS now allowed M&A allowance to be transferred under the group relief system? Really?
Even for the current treatment, M&A allowance is not allowed for transfer under group relief, nor is it allowed to be carried back. So these are the general rule now. So, and with this new budget change, there is no mention of lifting that restriction. So the old rule applies. The answer is no. Yeah.
Okay, I guess that's one of our wish list.
Yeah.
Yeah, okay. Okay, I think I can only take one more question. And this one concerns the upfront certainty of non-taxation of companies on gains on disposal of ordinary share. And this has been extended to 31st December 2027, which is good. However, noted that the scheme will now not apply to disposal of unlisted shares in an investee company that is in the business of developing immovable properties in Singapore and or abroad. So that's new, especially the abroad one. My company has been holding such shares since 2010. Does this mean we are now excluded from the benefits of this scheme? Cindy?
Well, just to recap, under the current rule, as you know, the minimum shareholding is 20%, yeah, and you must hold the shares for, at least 24 months. And it specifically says it excludes those shares that is held in investee company, which are in the business of trading or holding real property. And under current rules, it says, but excluding development of properties. That means, under the current rules, they only restrict you if you are just holding and trading in real property in Singapore. So going forward under the proposal, they are restricting further. So they are looking at property in Singapore as well as abroad. On top of that, even if you are in the business of developing properties, is also excluded. So in short, they are taking away all the benefits pertaining to property related transactions.
Yeah, I'm just wondering why include abroad.
I guess they probably just want some uniform treatment, yeah, it is a bit unusual to see that they try to extend it to properties overseas as well.
Yeah, okay. Okay, I guess we have come to the end of this webinar, and thank you very much and have a good day.
Experience RSM.